Hi, I'm Valerie Leonard with Grinkmeyer Leonard Financial, and today I'm going to be attempting to answer the question, how much longer might the stock market rally last? At Grinkmeyer Leonard Financial, our award-winning team is here to support you and give you access to the latest information and advice that can help you make confident decisions about your money. And today we're going to take a look at the stock market trends that we're currently seeing right now and how they might affect you. So let's take a look at the S&P 500. This chart goes back 2 years, and this chart was published midday. Today's Monday, August 23rd, and it captures the volatility that we saw last week in the stock market and then the subsequent rally that we've seen the past few days. So when we're looking at charts and we're considering the direction of the market, it's always important to keep an open mind because we know that conditions can change very rapidly, and that as a prudent investor, it's always important to be asking two questions kind of at the same time. So what would make this market go higher and what might make this market go lower? And we're going to address that later on in the presentation. But what's most interesting to note about this chart specifically is the strength of the uptrend. So do you see how frequently the market is pulled back to the green line going back to June of last year? This green line is what we call the 100-day moving average, and we kind of see it as a floor in the market. So look at how it keeps touching that green line and bouncing off of that. And since June of last year, when it broke below the green line, it touched the blue line 3 times and it bounced higher. So what might this mean for you as an investor? Now, the green line here in this case, based off of where the market is trading today, would represent roughly a 3% correction in the S&P 500. And the blue line would represent a 5% pullback. And then the red line would represent about a 10% correction. Okay, so these are all kind of critical points in the market. But even if we saw a breakdown in the S&P to these 3 levels, it's important to note that the uptrend would still be intact, meaning we wouldn't necessarily be entering scary bear market territory like some investors may fear as long as we hold up at those levels. So why specifically did I pick these levels and why are they important to you as an investor? So I want to take a look back at stock market corrections going back to 1945, and then we're going to talk more about future rallies and other risks for the market. But this is an interesting chart. Guggenheim Investments published this study about 2 weeks ago, and it shows that stock market sell-offs by as much as 20% are fairly common and have taken investors historically anywhere from 1 to 4 months on average to recover. Now, think about that. 1 to 4 months. That is a very, very short period of time. So as you can see here, there have been a total of 84 corrections, somewhere between 5 and 10%. And the average has been a 7% sell-off. And historically, in those 84 cases, it's only taken 1 month for investors to recover from those events. And then if you look at the 29 sell-offs of anywhere between 10 and 20%, with the average of those sell-offs being about a 14% decline, it only took 4 months on average for investors to recover. So if you put this into perspective, this creates an excellent argument that you should not always worry so much about your investment returns in the short run, and that you should focus more on long-term results. Now, having said that, we do know that the market has declined over 20 to 40% 9 times over the past 76 years. And those events have taken roughly 14 months for investors to recover. And there's also been 3 times where the market has done much, much worse with an even longer recovery time. So this is where you as an investor, and those of us where 2008 is still very fresh on our minds, we need to weigh the fact that 10% of all these cases represented over a 20% decline. And then we've got to determine which risk management strategies might be best for you. And so this is where you get to decide how much risk you want to take personally. And when you're thinking about risk, I want you to think about diversification. So if we know that 90% of all stock market sell-offs historically represented less than a 20% correction, how could we protect ourselves against the other 10% of cases where the market did much, much worse and took longer to recover? So one of the most important decisions you as an investor can make is how you're going to divide up your growth assets from your income producing assets and from your inflation protected assets and even more defensive assets. And this is where most investors second guess themselves, or maybe they don't spend enough time trying to understand how different asset classes work together and how they can benefit you potentially over the long run. So we know that diversification can't always protect you from losing money, but it can potentially help you avoid large swings in your investment portfolio. And for some investors, they don't necessarily want a lot of ups and downs, and that may be you. You may be more aggressive, but if you're wanting to try to take some of the swings out of, the big movements out of your portfolio value when you open up your statement every month, a truly diversified portfolio is what you need to consider, and that can be hard to achieve. This is where it's often helpful to work with a qualified investment advisor who can help you build this portfolio, and also, once it's built, help you understand what you might expect as far as investment returns based off of different market conditions. So, one thing that I am seeing right now that's been most common to 2021 is that a lot of investors are not necessarily comparing their investment returns to the right measuring stick. Maybe they're comparing their portfolios to a friend's portfolio, and it's more of an apples to oranges kind of approach. And so what I want to do is help you make sure that when you think about how your portfolio is performing this year, you're using the right measuring stick to do that. So let me explain. Every color that you see on this chart represents a different class of investments that you could choose to invest in. And these different asset classes could help increase the odds that something in your portfolio is always working for you, or something in your portfolio is always helping to protect you. So let me give you an example. If you look at the far right column, which represents investment returns through the end of the second quarter of this year, you can see that the bright blue box at the very top represents small cap value, and that is up 26.69% for the year. That's been the best performing investment category. But at the bottom, if you see that orange box there, which represents fixed income, that's been the worst performing major asset class, and it was down about 1.6% over the same time period. So you can also tell from this chart how other major asset classes have performed this year or even over the past decade. But what you're going to notice when you look closely is that choosing to invest in one area means you're never going to own the best performing or even the worst performing asset class every single year consistently. This is why it's important to have exposure to all the different colors on this kaleidoscope. So if you are comparing your specific portfolio and the returns you've seen this year to one single asset category, I'm going to use the S&P 500 because it's the most widely used index when you turn on the TV to see how the market's doing. The S&P 500 represents large cap stocks. So if you're comparing your portfolio to that, you may be comparing apples to oranges, like I said. Your portfolio may need to be compared to a more blended mix of investments if you're diversified. And that's going to give you a true apples to apples comparison and help you understand whether your investments are performing appropriately. So to that point, the yellow box that you see here represents a more blended index of investments. So as of second quarter this year, this blended index was up 7.11%. And this is what a more moderate investor might have expected out of their investment performance. So not aggressive, not conservative. So 7% or so is what a balanced investor might have expected. But the S&P 500 over that same time period was up roughly 15%. And this is what a lot of investors have used as their measuring stick. So we just want to make sure you're using the right measuring stick that's designed similarly to how your portfolio is designed. So we know the title of this presentation is How Much Longer Might the Stock Market Rally Last? And just like I pointed out on the previous slide, not every asset class is going to perform in tandem with each other. So let's take a look here at small cap stocks. I'm using the Russell 2000 index, which is going to represent more of a blended array of growth and value small cap companies. And as you can see, this index has traded mostly sideways for 2021 between the blue lines that I have marked here. So if your specific investment portfolio hasn't performed as well as the S&P 500 so far this year, this could be one reason why. But did you know that over the past 5 years, the Russell 2000 has performed on average over 16% a year? And so this is a great example of why it may not make sense to dump your small cap positions based off of just short-term consolidation in this one area. And one more note that I'll kind of point out while we're on this chart is that we're really at a pivotal point right now. So if you think about the broad stock market and you're wondering, is the market going to sell off? I would think, based off of my experience, that small caps in general would be trading lower if there were more weakness in the market. So right now, the pattern appears to be clear consolidation, which means sideways moving markets in the small cap space. And unless the markets produce a new catalyst for a future sell-off, I feel like things are holding up pretty nicely in the small cap space. So there's lots of factors that could lead to a weaker market. Among the most likely risks that we're seeing right now would include action by the Federal Reserve. So all eyes are going to be on Jerome Powell this coming Friday and all the comments he's going to make about the Fed's involvement in financial markets. Right now, they're doing two primary things that are supporting markets and keeping investors calm and making markets more smooth. And that includes interest rate policy. So we know that they're going to potentially raise interest rates going forward. So we're looking to see when that might happen. And then also, if they were to taper their asset purchase program and scale back on that, that would probably mean that investors would lose a little bit of confidence in the market. And so that's something we're watching closely. We're also watching employment data. We're looking at things like retail sales, industrial production, the service sector activity, and how confident consumers are here in the United States and even throughout the world. There's no surprise that COVID-19 shutdowns can certainly spook markets, but for the most part, investors have largely ignored the most recent surges that we've seen in case counts. I'm also watching supply chains, the amount of borrowed money that is being invested in the market. Of course, inflation is one we're watching closely, and then the yield curve, so how bonds and interest rates work together. And don't forget, it's always the bus you don't see coming that might hit you. So keep watching for future surprises and continued volatility throughout the rest of 2021 and into 2022. We're always looking for that bus. But personally, I believe that the U.S. is positioned for future growth based off of what I'm seeing in current market trends, based off of investor behavior, based off of the fact that consumers right now are in a pretty good place. There is currently $2.4 trillion sitting in American savings accounts, which means that there's lots of potential for future consumer spending. And as long as consumers continue to demand more goods and services, this could lead to higher profits for companies. We could see higher corporate spending on things like automation. We could see more jobs for consumers, more home buying across the board. We already know from corporate earnings that we've seen this earnings season that companies are still profitable, that margins are starting to improve. So in the end, we have lots of economic momentum. And I believe that we can reasonably expect this market to potentially move higher. So if you're looking for investment advice for your money, I'd love to hear from you. And don't forget to subscribe to my channel and be on the lookout for future video content. Until next month, I hope you have a great investment strategy in place, and I'm happy to help you if you have any questions.